Good afternoon, everyone, and welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president. Thank you for joining us for our first online virtual event. We, of course, have been web streaming our events for several years now, and we've had a number of offline closed events for our stakeholders. Today, we are having, of course, the semi-annual Global Economics Prospects event that we do just ahead of the IMF World Economic Outlook under the baton of Karen Dynan. We believe we can make a contribution discussing the global outlook, even though we are not an investment bank, let alone the IMF or the OECD, with expertise in depth on every single country and a large econometric model. We think we can make a contribution in these sessions for a bunch of reasons beyond just simply the brilliance of my colleagues. First, that being unconstrained by either market positions or official positions, we can make calls that others may be reluctant to do. We hope to be unbiased. Second, we are political economists, partly by training and partly by experience, that many of us have actually worked in the policy sphere. So I think we can make better judgments sometimes, not always, about what the actual policies are going to be, how they will work, and their ultimate impact on the forecast. And third, we have an ability to focus on topics and say, this is the theme. We are not concerned with getting the point estimates right. Obviously, that is no more true than ever today, or more true than ever today, excuse me. The Karen Dynan, Martin Chorzempa, Olivier Blanchard, and our colleagues in the Peterson Institute team have all contributed to a forecast where there are, of course, point estimate numbers, but in light of the incredibly fast-moving COVID virus and as a result, the incredibly fast-moving economic situation, we do not want to pretend to false precision. Karen Dynan will take us through the overall forecast for the US and the major economies with a deep dive into the US. Olivier Blanchard will take us through the fiscal policies, the fundamental principles and guidelines for them that he has played such an incredible, timely role in setting, and how he sees the responses of policy playing out on the fiscal side. And then Martin Chorzempa, our young rising star working at the intersection of fintech and Chinese economic studies, will take us through some reflections on how attempts at recovery and disease constraint in East Asia, including China, will affect their prospects for recovery with lessons for the West. Thank you all for joining us. One administrative operational note, we are doing this in a two-tier system. Our stakeholders and accredited press members are invited and have registered to participate via Zoom. They will be able to ask questions either by filing a Q&A or by my recognizing them and unmuting their mic. We welcome as many other people as possible to watch this event, obviously, and discussion in real time. And later, all of this is available on the web free of charge. We simply have to limit, just as we do with live in-person audiences, the questions to those who are present. Let me now just briefly reintroduce our three speakers. Karen Dynan is a non-resident senior fellow at the Institute and is professor of the practice of the economics department at Harvard. She has been running our semi-annual global economic prospects since she left the Obama administration, where she served as Assistant Secretary of the Treasury and the Treasury's chief economist during Obama's second term. She has a distinguished career at the Federal Reserve and in other capacities. And I rely on her, and she's done great work for us. Second speaking is Olivier Blanchard, the C. Fred Bergson Senior Fellow at the Peterson Institute. Olivier, of course, is recently the president of the American Economic Association, solo professor of economics at MIT, and frankly, the world's leading applied macroeconomist who we all turn to in times of crisis. He, of course, served as chief economist of the International Monetary Fund during the long stretch of crisis in the early 2000s. Finally, I want to introduce, in sort of his most prominent debut on our stage, Martin Chorzempa, a research fellow at the Peterson Institute. Martin joined us after several years working in China, including at the People's Bank of China, with our colleagues at CF40, a Chinese think tank who we partner with. and who is now completing a book for us on the development of fintech in China and its implications for the world. Martin is fluent in Mandarin and has been an incredible asset to us with his spirit and energy since joining the Institute, I believe 2 years ago now. And we look forward to his remarks as well. We're going to have Karen, then Olivier, and then Martin speak. I will make a few brief comments, and then we will go right to questions from our stakeholders. Thank you very much. Karen, over to you.
Thank you, Adam, for that nice introduction, and thank all of you who are out there participating in this virtual event. I'm going to offer thoughts on how the pandemic is affecting the global economy now and what the prospects are for the future. As Adam said, it's exceedingly difficult to write down numbers at this point. Even within PIIE, I can tell you there has been a lively conversation with a wide range of perspectives, but I think it's valuable to try to lay out the sort of logic we're using as it helps frame thinking as we react to incoming news. Okay, so the starting point is that economies across the world do seem to be making progress containing the virus through shutdowns and other measures. So as you can see in this graph here, which I think many of you are familiar with, countries are indeed bending the curve in terms of growth in virus-related deaths. And that is unquestionably good news for society, unquestionably. But it's also causing a plunge in economic activity through a number of channels. So we're seeing an unprecedented drop in consumer demand for many services. That's because services generally require interacting with people. We're seeing a sharp slowing in production of many goods as employees can't get to work and supply chain disruptions take hold. And we're also seeing very important knock-on effects, including in financial markets, liquidity crises, drops in asset prices, as well as a surge in unemployment that's limiting income. Before showing you my forecast, I want to emphasize that the rebound, once activity starts to, or once activity starts to normalize, is going to depend on three factors. The first is how dangerous and contagious is the virus. The second is how quickly countries can build capacity for testing, tracking, and other means of reducing contagion after the shutdowns are eased. And the third is how much can aggressive policy responses limit the damage to the economic structures during the shutdown. And my forecast is going to take best guesses at the answers to these questions, but obviously a lot is unknown at this point. Okay, so for the global economy, we're looking at a slump this year that's considerably sharper than what we saw during the financial crisis, but also significant recovery that begins in the second half of this year and produces sizable growth numbers for next year. So in this slide, I'm showing you my assumptions for the global economy and for high-income economies. For the most part, it's a fairly similar story, although there are some differences across countries depending on, for example, what's normal for the economy, what the underlying strength of the economy was going into the crisis, and also factors like trade dependence. Okay, so on this slide, I'm showing you my assumptions for China, India, Russia, and Brazil. And again, you can see pandemic effects very clearly with softer growth or declines this year. Some differences in country, though, depending on where the countries are with containment. That applies to China in particular, which is ahead of other countries, but also differences in, again, what's normal for the economy and differences in underlying conditions and also their exposure to shocks. So for example, some of these countries like Russia is a big oil exporter, they're going to be hurt by lower demand for oil. Okay, so that's the global forecast. There's an addendum at the end of my presentation that has the precise numbers for each of these countries, which you can look at after we get the slides posted. I want to take a deeper dive now on the United States. Okay, as yet we have scant hard data to go off of, but early indicators suggest a sharp cutting back of activity. So on the left here, I'm showing you a weekly economic index that has been developed by my Harvard colleague, Jim Stock, and some people at the New York Fed. And it's basically based on things like UI claims, rail traffic, fuel sales, chainsaw sales, and some other indicators. But you can see very clearly in this weekly index a plunge in activity. The plunge that we're getting here, much of that is related to the big spike we've seen in weekly unemployment insurance filings. So if you're wondering where that's showing up, it's showing up here. On the right, I'm showing you light vehicle sales for March. You can see they plunged, even though they plunged into basically Great Recession territory, even though that was a month of only partial shutdown. So we can expect worse for April. The cycle I've written down for the United States is what I'll call a checkmark shaped cycle. That actually is a term that I coined, that I think was coined by our own Adam Posen, so he gets credit for that. But basically what you can see on the left is I've got the level of real GDP in my projection, as well as on the right, growth rates, okay? And so for the second quarter, I am projecting a 50% decline in real GDP. That's at an annual rate, okay? And what that involves, these are kind of quarterly levels I've plotted. If you looked at monthly levels, you would see an even sharper kind of decline in the second quarter. But basically, it's based on an assumption that activity runs a fifth below normal in April and May before beginning to rebound in June. And then we see pretty brisk growth for 3 months after that, digging maybe halfway out of the hole we've fallen into by the end of the third quarter, and then activity kind of asymptoting to normal. Now, whether we actually see a path as smooth as that, I think is unlikely, because I think as we basically let up on shutdown measures, we will see some zigs and zags as we find that the virus is not contained and we have to shut down again. But basically, this is the contour I'm expecting. Okay. So what does that map into in terms of the unemployment rate? I've got the unemployment rate rising to an average of almost 20% in the second quarter. That will be the highest level we've seen since the Great Depression. I want to emphasize, first of all, there's a lot of uncertainty. I also view this as a lower bound. My colleague David Wilcox at Peterson has done some bottom-up calculations using the initial claims data. And his forecast based on those data is that we could easily see 20% or higher in the second quarter. Okay, so turning to the issue of scarring. I want to start first with a couple of slides on households, then turn to small businesses. So as you can see in this slide, there are households in the middle and lower part of the distribution that have scant financial assets, particularly when we're talking about liquid financial assets. In the first and second quartile, it's just a few weeks of assets, even when you're looking at the total numbers. So they're operating on thin margins. Okay, and we've already seen some types of delinquency rates rising. On the left here, you can see selected delinquency rates for households. Mortgage delinquency rates have been low since the financial crisis, but you can see a rise in credit card delinquency rates and also auto loan delinquency rates, which is in large part related to an expansion of subprime auto lending. So we're already seeing some households struggling, but in the right, you can see that there's been a big pop up in the number of households who are in the middle and lower part of the income distribution who are expecting, just based on what they saw in March, which again is not the worst of it, to have problems paying their debt over the coming year. Okay, small businesses are operating on thin margins. Here's some selected data points on that. As you can see, small businesses, the median small business in the big cities I've got here only has a couple of weeks of cash to be able to stay afloat. We saw, even in last year, which was a good year for small businesses, a very large number of small business businesses reporting some sort of challenge paying operating expenses or paying off their debt. Okay, so there are vulnerable households and businesses. I think their vulnerability will be helped by the aggressive monetary and fiscal policy steps that the United States have taken. So we've seen dramatic action by the Federal Reserve. They've cut policy rates. There's been a big expansion in large-scale asset purchases. They've done dramatic lender of last resort interventions, building on basically the financial crisis playbook, including many liquidity facilities aimed at domestic strains, also importantly, swap lines with other central banks. We've also seen an unprecedented expansion of fiscal policy to address public health needs, to limit the damage to the economic structure, to protect the vulnerable, and finally, to stimulate aggregate demand. Okay, here's a picture of the Fed's balance sheet. You can see very clearly already they've started to expand the liquidity that they're providing to the market. I took the vertical scale on this graph up to 10 trillion because our best guess is that the balance sheet will get as large as $10 trillion before it starts to normalize. Here's some information about the aggressive US fiscal response. We have so far put in more than $2 trillion. This is this graph just shows you what the CARES Act consists of. Importantly, you can see in the upper right quadrant, the enhanced unemployment insurance benefits. That's a big deal. It's a lot of money for people at the bottom of the income distribution who've lost their jobs, as well as kind of the expansion into people who are not normally covered by unemployment insurance, like gig workers. Direct payments to households are there. In the lower right quadrant, you can see the small business loans. I put in the parentheses the subsidies, because really a lot of these loans will turn into grants or subsidies because of the forgiveness built into this program. And then in the upper left, you can see the important aid we have to state and local governments and healthcare systems. Okay, few additional thoughts on fiscal policy in terms of what comes next. First, we need to be focused like a laser on the implementation of the CARES Act. I think it's going to be challenging in some areas, but it's just crucial that we get this support to households, businesses, and states and localities. I think in particular, we're hearing some anecdotes that suggest a rocky start to the small business lending part of the CARES Act, but it seems like the policy community is trying to respond to those challenges and smooth them out. In addition to the fiscal policy we've legislated, remember, we're going to get support for the economy through automatic stabilizers. There, I think that's going to add about $1 trillion to the amount of spending and tax relief we've seen so far. And then, of course, we have more fiscal policy to come. So we're already talking about phase 4. This will include more funds for small business lending. We think what we've done so far will maybe only cover half of small businesses. States and localities need much more support. And we're going to need to put more money into unemployment insurance benefits. So we're going to see considerably more fiscal policy on top of the aggressive response we've already made. Okay, Olivier is going to talk more about this, but I want to mention that, of course, with all of this fiscal policy, we are going to see a considerable spike upwards in deficits and debt relative to GDP. On the left, I have debt to GDP, a very rough approximation that's based on some calculations that our PIIE colleague Jason Furman did, assuming considerably more spending, but you can see it's a big deal. It's a higher rise in debt relative to GDP than we saw during the global financial crisis. As Olivier, I think, will talk about, whether we need to worry about this additional debt, the answer is probably not so much, because we've seen this large decline in government borrowing rates based on factors that have happened slowly over time. So we don't think we're going to see a big reversal. And then the last thing I want to cover in my presentation is my outlook for inflation. Here, we think that inflation is going to be buffeted by cross currents, but that the net effect is likely to be negative. So in particular, there's been a lot of talk about with all this policy that will support aggregate demand, but we know on the other hand that production is constrained. Do we worry about that causing a lot of inflation? For sure, we're going to see supply constraints raising the price of some goods. We're already seeing that occurring. But at the same time, we're also already seeing softness in prices in some services. We're seeing softness in rents, and we're seeing it in some goods sectors where demand has dropped sharply, like apparel. We're seeing it, of course, in oil prices. So all these things, I think, are going to provide an offset, or more than offset, any supply side effects. And I think we'll see soft inflation below the Fed's target for the coming year. Okay, so in conclusion, I just want to say that this has been a hard exercise, but I hope that seeing the underlying logic will help you kind of think about where the economy is going to go as we get more information about the virus and about how the economy is evolving. I will just comment that neither epidemiologists nor economists have any analogous experiences in modern times on which to base their forecasts. So it's just a very unusual period. I think important things to watch include how quickly deaths and hospitalizations flatten out in Europe and in the United States, the extent to which countries in South Asia, Africa, and Latin America become infected. We know many of those countries are already dealing with infections, but what kind of trajectory are they going to see from here? China's success at rebooting its economy, Martin will be talking more about that. And then the really important thing, the rate at which testing increases in the United States and other countries, because that's just going to be so critical to our ability to open up the economy again. So that's all I have. Thank you. And with that, I'm going to turn things over to Olivier.
Somebody has to give me permission to share.
Oh,
okay, thank you.
You have permission.
Thank you. Thank you. Good. Okay. Happy to be here in some virtual way. I thought Adam asked me to focus on the fiscal policy aspect of a crisis, and it's clear that that's the main tool we have to deal with it on the economic side, and so that's what I'm going to try to do. I have 4 slides. The first one is that we really need, with respect to this shock, to completely rewrite the fiscal guidebook. I was looking at my textbook, and my textbook is, when it talks about fiscal policy, it's thinking about a very different type of shock from what we have. It's a completely different shock. I mean, the typical recession is a demand shock. Demand is weak for some reason, and the question is, how can we move it up? This time, it's a supply shock, and it's a very special supply shock. It's not like an oil shock or anything that we've seen in the past. It's the lockdown, in effect. It's a closing of non-essential activities and firms. It's the effects of social distancing, which actually affect productivity in various ways. So it's policy-induced. That's the irony of it. It's needed to fight the virus. It's incredibly brutal. It's incredibly sharp, and compared, for example, to the effect of, again, an increase in oil prices. This is something which happened within a week when we went into lockdown. And the difference, again, is that with respect to supply shock, potential output goes down, but you can still stay above it. It's going to generate inflation, but you can do it. Here, it's binding. And when a firm is closed, it's closed. And there is no amount of demand which is going to make production go up in that firm. And that's a very important characteristic of that shock. Now, turning to the part of the epidemics that we need to think about in thinking about fiscal policy. It's clear that there are two phases. And again, that in parentheses, there's a very important caveat, which is what I'm going to say for the next 5 minutes or so is going to be about advanced economies. Middle income and poor economies really are subject to a different set of issues, and I'll come back to it. But in advanced economies, you have two phases. The first one is getting the infection rate down, which we're slowly doing at this stage in most advanced economies. And I would say it's more or less baked in. There's some uncertainty as to when the peak is reached and when we get down to a very low infection rate. But in fact, it's across countries, in most cases, we're fairly confident that by early summer, we'll basically be down to a relatively low infection rate. There's much more uncertainty about the number of deaths between now and then than about the timing. So come summer, then we'll have to keep the infection rate down, and that's where there's a very, very large amount of uncertainty. There's uncertainty about the virus, which is how many people have immunity, how long does it last, and then uncertainty about whether we'll be able to get drugs, vaccines, tests in time. Big uncertainty, given that tests really look like a very important thing before we get the vaccines, is the scaling up potential of test production, which will make a big difference to the degree of lockdown that we can afford. I would say that we could basically be back to potentially to all potential output within 6 months by the end of the year, if we're very lucky, but it might last another year, and I think 2021 is not a sure thing at all, so 18 months. So this is the background in which I think one has to think about policy in general and fiscal policy in particular. I think that in this case, there are 3 goals for fiscal policy. There's infection fighting, there's disaster relief, and there's aggregate demand support. And each of them really has its own set of difficulties or challenges, if you want. Now, infection fighting, there are 2 parts. In phase 1, that's done. And fiscally, there's not much more we can do. We have the capacity constraints that we have, and we have to deal with that. The big issue, I think, is in how much we invest in the tests and vaccines that we need at some point. And here, the question is the scaling up of tests. There is a very interesting proposition, provocative proposition by Paul Romer, that if we could do 22 million tests a day in the US, we would actually be able to eliminate more or less confinement. Not sure he's right about the exact number, but the question is it inconceivable to do it? And I think the answer is maybe not. That's something that maybe we should look at. Same thing for the development of vaccines. There are plenty of reasons for the state to intervene, promise a sure amount if the vaccine is developed and is successful, and then be in charge of allocation. If allocation is left to the markets, it will be catastrophic, and that's a big issue. The first point is that that's essential, it's existential, but it's not expensive. Even if we do all these things, it's very hard to see that it costs more than 1% of GDP. And therefore it has to be done, but that's not where the fiscal policy really is going to cost. The second is disaster relief, which Karen has talked a bit about. There are liquidity constrained households, there are firms which are close to bankruptcy, there are local authorities which have to balance the budget having lost revenues. And there the question is what should be done. And there is an obvious trade-off between speed and targeting. You'd like to give it to the people who really need it, but you just don't know who they are and how to get to them. There are different approaches, and that's a fascinating issue from a plumbing point of view. In France, we decided to keep people on the jobs and have basically the state pay them. In the US, we've gone through unemployment and people receiving unemployment benefits. The differences are not that sharp between the two, but there is a difference of spirit which might be relevant for what happens over time. Should you give grants rather than loans? I think the idea is you prefer to give loans, but you're not sure. You probably want to go with grants most of the time. If you're going to ask banks to provide credit to firms so that they can pay their workers, you have to back backstop the banks, and maybe you have to backstop the Fed. These are all the issues we're struggling with. The point is that in the end, to do a half-decent job, and half-decent is, I think, what we can hope for, you have to be very generous. And at this stage, it's going to cost a lot. One of the challenges is that over time, I hope that we can do better, target better at less cost, and give incentives for people to reopen. For example, in France, sorry to take French examples, but I know French quite well at this point, people receive about 80% of their wages. That's not a very strong incentive to go back to work if you don't like your work. So I think there are issues there. So how much is the price tag? It varies across countries, but it's very hard to compare because some of it is grants, some of it is loans, some of it is backstop promises. I think that if you include the automatic stabilizers, you'll be probably around 10%, maybe a bit above for 2020. I realize that Karen actually came out with something like 3 trillion, which would be 15%. Maybe we want to revisit this. Then the last one is aggregate demand. In a normal recession, this would be the only item we would care about. The point is that we cannot go above potential. So there's no reason to want to push aggregate demand much beyond what can be produced. How much lower is potential under lockdown? I think the best number we have at this stage is an INSEE number, again for France, which is under full lockdown. The potential output is about 35% below baseline. I think that's a reasonable number to use. Then you have to decide how long it lasts and whether we can slowly go away from it. But what this implies is that, you know, you can give all the money in the world to people. If potential is 35% below normal, you can't get much above that. You'll get rationing, you'll get maybe inflation on some goods. It may not be the end of the world, but there's really no reason to do it. Now, when we get to phase 2, the issue will be what happens to private demand. And here you have two effects. You have pent-up demand from people who haven't bought cars in March, April, May. And then you have precautionary saving, which is likely to be very important because we all understand that the environment is still going to be very uncertain. The probability that we have to go back on lockdown is high. So my guess is that demand may go up or down. The important conclusion from this is I would hope that we don't commit to something very specific now. We are ready to do it. But for example, some people push big investment projects. That would not be the thing to do, as much as I love investment projects at this juncture, not the right thing to do. 2 more slides. That's sustainability. I think this will very soon become the big issue, which is, you know, we've gone from whatever it takes, which is the spirit at this point, to something like, oh, gosh, what have we done and how do we repair the damage? And as Karen suggested, I think that in fact, that will be sustainable. By how much will that go up? Hard to say. I think 30% is a reasonable upper bound for the debt ratio, debt to GDP ratio. And then whether we can sustain it or not depends very much on the old comparison between R, or R star, the equilibrium safe rate, and G, the growth rate of the economy. Before the crisis, R star was expected to be very low for a long time. Yield curves were very flat. It was expected to be much less than G. What will happen after the crisis? I think more of the same. There'll be more saving, probably more precautionary saving, less investment given the uncertainty. So my guess is that we're in a world where for many, many years, we basically have zero rates of something very close, which means that the debt service from even 150% of GDP is actually not very large. And we don't have a need for crazy stuff, big primary surpluses, big tax increases. Eventually we'll have to get there, but I think not in the next few years. The point here, the last point on this slide, I think is important, which is, this is what I believe, but I'm not an investor, at least I'm not a big investor, and investors may well disagree. They may say, no, you're completely wrong. That's crazy, that is going to explode. And then they start worrying, they start putting spreads, and that interest rates are high, that service is high, and everything goes down the drain. I think to avoid this, it's very important that central banks make sure that we don't get on that path, that we keep what I call the good equilibrium, which is what the BOJ has done with yield curve control, which is basically just way of making sure that we don't get these self-fulfilling bad equilibria where worries just lead to spreads, which lead to worries. So my guess is, we may have to think about that sustainability at some point, and maybe one day we'll have to basically inflate it away. I don't know, but I just don't see it in the reasonable future. Then the last slide is on middle income and poor countries, and there the story is much worse. They have a perfect storm. They have the virus. They have a very weak health system, even with all the help we can give them. And so I think the dynamics will be much more of a herd immunity type, which is a lot of deaths and then immunity, collective immunity. Not a pleasant scenario, an awful scenario, actually. Then they have the drop in commodity prices, oil prices, but the others as well. The disappearance of tourism, very large capital outflows, and much more can come out. And the fact that in that situation, many of them have dollar-denominated debt, very steep supply curves for farms, very limited fiscal space. It's really a very difficult situation they're in. So looking and having talked to people who work in these countries, I think existing debt may have become unsustainable. And additional borrowing from private creditors may just not be there. So the implication is we have to help. The rest of the world has to help, provide funds to fight the virus, and that has to have a form of grants or loans at very, very low rates. But there's going to be a need for much more than that. And this is going to take the form of programs, presumably at the fund. I think the implication is that there'll be debt restructuring on a large scale. We may wait for it in many countries, have debt standstills and see how it goes. But I have no doubt that at the end, debt restructurings will happen in many countries. And that has an implication, which is that restructuring means that creditors get less money. Many of the creditors are advanced economy financial institutions. And this, plus potential problems in the domestic banking system in those countries, means that we may have to think about fiscal implications of that as well. And that may add to the bill. Let me stop here and give the mic to Martin.
Well, before Martin, thank you, Olivier. I just want to flag that the Peterson Institute team is getting out a new ebook on Monday addressing what the G20 should do, and more importantly, that they can do things that are constructive. Mario Obstfeld, who succeeded Olivier at the IMF, is now back at Berkeley, and I are the editors. A team of 12 of our fellows are part of it. A number of the main focus is about what's going to happen to the middle and low income countries, as Olivier pointed out in this last slide. That for example, the central banks in the advanced countries have done a marvelous job of stopping financial panic in the rich world, but the financial outflows from the poor countries and the financial seas up there is far from over. So those memos are already appearing on the Institute website. Some of them have already been in the hands and discussion by policymakers, and the full volume, e-volume, will be quickly out by Monday. That said, today's focus is on the advanced and large economies and the forecast, not on the policy. So let me turn to Martin Chorzempa, who's pulled together a great deal of information to try to assess the medical and economic foundations for East Asia's recovery. Martin, thank you.
Thank you. Let me pull this up. So I'm going to talk about epidemic control and economic recovery in East Asia, which is actually in many ways a look into a potential future for the other economies. Most of these countries are so far, at least appear to be, in what Olivier described as phase 2, with the virus mostly under control. Okay. I'll begin with China, where a costly lockdown did contain the outbreak. This chart shows the number of daily reported cases new every day in China. These are from the Chinese authorities. On January 23rd, the draconian step of locking Wuhan, which was the initial epicenter of the outbreak, was locked down. And 2 days later, almost all provinces in China declared a state of emergency. There was a hard line to contain the spread of the virus, and everywhere from rural areas were completely locked down to places like Beijing. Pretty much the entire country was at home. Already, there was signs of economic strain that led the political bureau, the highest political body in China, on February 3rd to start supporting the idea of getting back to work with heavy strings attached, of course, to make sure that there was not a second outbreak. You'll notice that that was actually before they even reported a started decline in the new cases. So they were already talking about it quite early. A few days later, the State Council asked provinces to plan for a staggered reopening based on the areas that you can get the most payoff, but with the least risk. The chart spikes again there for some problematic data reasons. But you can see that actually a month after they started to plan for the staggered reopen, only half of small businesses were back to work, which shows you that it took quite a while for this to happen. I would note that these case data and also the death data are seriously underestimated, partially because of the initial cover-up and problems in the Chinese system. There's a strong incentive for local authorities to report lower infection numbers than they're actually seeing. Some were hidden. Some were hidden because of local being reported as asymptomatic cases. But if you look at the government's actions, I think it suggests a real containment and recovery, especially this last piece on the timeline when Wuhan stopped being locked down, people could leave. This is a sign that they think they have it under control, even in the original epicenter. So the cost of containment, however, was enormous. On the right side here, we have some of the economic indicators for January and February. This is a year-on-year comparison of 2020 versus 2019. You can see fixed asset investment went down by 25%. Retail sales were down over 20%. Many would not expect that China would be willing to produce such negative statistics, but they did. However, even these are underestimates of about 30 to 50% of the actual decline, partially because the normal January data were combined with February, in which most of China was locked down. This is not a nefarious plot. This is, they always combine these data because of the seasonality effects of the Spring Festival. There's also an enormous social cost in China. On the left here, you see a photo which circulated around the Chinese internet of authorities, maybe your local HOA, which you might dislike, but at least they're not welding your doors shut to enforce your quarantine like happened in China. And the process of reopening has also not been terribly smooth. You can see in the bottom a riot with overturned police cars because a neighboring province to Hubei, which is the initial epicenter, was worried about people coming from Hubei, tried to lock down the border, but the people wanted to leave anyway. And there was a scuffle, including altercations between the police forces in both areas. The recovery has been good in China, but it's still stuck at around 80% optimistically. You can see the chart on the left shows that the recovery has begun to flatten out. That's partially because the quarantine has not been fully taken off. There are still a lot of social controls in place, but also global demand has collapsed. So there's no reason to run factories at full capacity unless they're producing medical items that can be exported. And you can see also that small businesses took longer to resume activity. Despite some packed places, holiday tourism revenue from the latest holiday, which was last weekend in China, revenue was down 80% from the previous year. So although they generally feel like they have the virus under control, people are not going back to their usual daily lives as it would have before. And they are using this system with QR codes, where you have a green QR code generated by the Alipay app. And if you don't have that green code, then you're stuck at home. Your code could turn red or yellow if you go to a potential hotspot, if you're around or in contact with a close case. But actually, we don't really know. It's a very untransparent system. It's how they generate these QR codes. Major stimulus is definitely coming in China, but has so far come later than most of the world, which is a bit surprising, a bit of a reversal from the financial crisis when China had one of the largest responses. Next is an even better scenario, better set of countries in terms of handling the virus, because they were able to keep their economies open and to a great extent without locking down, without the draconian lockdown of China, partially because they were able to act more quickly. On the right, you see the daily new reported cases of Singapore in blue, Taiwan in red, and Korea in the other. Korea had one of the worst outbreaks at the beginning, but managed to get it under control quite quickly by early March, and has remained low since then. Taiwan is another country you would have expected to have a terrible outbreak because of its proximity to China and the level of contacts between the two, but they took immediate action, were able to keep that low. Singapore was also able to keep it low. In many of these places, up until recently at least, you had, in Singapore, you had schools open, restaurants were open. Life was very much more like normal there compared to Western economies because of the rapidity of their response. Singapore's had a bit of a resurgence, you can see, and I'll talk about that a little bit later. The key to this was rapid coordinated government response, with an emphasis on the rapid. The quick scale of testing early on allowed them to find clusters of infections and quarantine only those people, say a more micro intervention, instead of locking down the entire economy. And one of the keys to this was rapid contact tracing, because once somebody begins to have symptoms, the people that they infected are just beginning to become infectious. So time is really of the essence in finding those people and isolating them quickly. It wasn't just apps. In Korea, for example, they posted online the whole travel history, exactly which seat in the movie theater, for example, a confirmed case was in, so that people would know if they needed to isolate themselves. There was also some social distancing, and travel restrictions, especially in the case of Taiwan, was incredibly important in reducing the threat of imported cases. Mask wearing, the science is increasingly suggesting that the mask wearing norms in these countries played a big role in making sure that asymptomatic cases did not spread. And one of the aspects of their response, which has not been copied as much in Western countries and others as they should, is separate quarantine facilities. So you don't have infected people going back home, infecting the other people in their home, and they're also not going right into hospitals and turning hospitals into hotbeds for infection. Instead, they have these places where they're under medical observation, and that allows them also to get to people with the right medical care before they deteriorate. So they've had a bit lower death rates. This is too late to achieve for most countries, at least at the beginning, but this is what we can hope for. These kind of responses are what we're going to need in other economies if we want to be able to run the economy without an outbreak as more like normal. But we have some worrying recent outbreaks in Singapore and Japan. Unfortunately, in many of these places, recovery is fragile and subject to reversals. The chart on the left comes from Singapore's health authorities. You can see they got a handle on infections early on, but then starting about the second week of March, you have these blue imported cases, which pretty quickly turn into new clusters of linked cases where they know where the infection began. Those are yellow. Those are more able to be contained through the micro interventions. But then the unlinked cases are ones that they don't know how to trace. And you see that unlinked cases start to go up as well, which would suggest that there's community transmission. They don't know who to quarantine. And that has led Singapore to introduce their first lockdown, which is quite draconian. Vietnam also recently imposed a lockdown. So although Korea, Taiwan, and Hong Kong so far have been able to fight off a second wave of cases and remain under control without lockdowns, they're still not fully back to normal. China has also locked down one county and one city. The city is near Russia. There are imported cases from people, Chinese people who are returning from Russia. These lockdowns affect a total of about 700,000 people. So we can expect that these are probably not going to be the last examples of this. And the resumption of work and travel in these places is just going to create risk, and it's going to be true for all of us. One note on the importance of testing for reliable data. It's quite normal to undercount deaths and cases in a pandemic. There's been a lot of worry and concern about the reliability of Chinese statistics. I think many of those worries are founded, but I would also note that in Western economies, we seem to be underreporting, partially because of an insufficiency of testing and partially because our systems are just overwhelmed. We can't count all these people. There's more reliable data in places where you have widespread testing, where the spread of the disease is manageable. So you have a sense that the tests you're getting are actually targeted well to capture the people who might be infected. And an open media environment, these are places like South Korea, but also in Europe, places like Germany. China has unfortunately not released data on their testing capacity, how many tests they're doing, which makes it also difficult to evaluate the accuracy of their data. Low testing in Japan makes it potentially at risk of an outbreak, which appears to be occurring because you're not able to trace the cases. So in conclusion, there's some bad news from East Asia, which is that it's extremely difficult to contain this at the country level when there's still a pandemic raging around the rest of the world. That means you're going to risk imported cases. So I expect that travel bans and mandatory quarantines for international travelers are not going to go away because these places are not going to want their hard-won progress. And also, countries that later on get a handle on their infections are not going to want to squander that progress through imported cases from places that were less good at containment. I expect at least localized reimposition of some controls in larger countries. I would expect that to look more like what China has done, where they're targeting it to specific cities or counties or areas that they think might be a next hotspot instead of an economy-wide. In smaller countries, it might have to be economy-wide, like in Singapore. And consumers are likely, at least looking at China's example, to be quite cautious in coming months, not travel, not go out to eat as much as they would have, which is going to slow the recovery because there's going to be a little bit of rise and fall and sometimes tripping of circuit breakers. The good news is that East Asia shows us it is possible with an effective government to contain the virus, to not have, for at least months, without shutting down the economy and with the service sector able to operate largely as normal. There are lots of unknowns, as Olivier mentioned as well. What are the biological determinants of a potential second wave? Is there seasonality? Is there a limit on acquired immunity? How far away would herd immunity be? That makes it very difficult to draw anything conclusive and to say that they've fully declared victory. Most are still in the fight. So thank you.
Thank you very much, Martin. That was excellent. I'm going to take the privilege to make a few comments of my own observations, reacting to and partially based on the work of my colleagues, but also my own views for what they're worth. I think first, just starting with Olivier, he didn't use the magic words secular stagnation or Japanification, but I think one has to take very seriously his underlying premise, which I agree with, that this situation is going to reinforce precautionary saving, reinforce low interest rates, and probably on net push down on inflation. I, in fact, am even more on that bandwagon about inflation than some. And so I think that, of course, is the context in which his fiscal recommendations take place. And I think if you're in the forecasting business, not the moral judgment business, that is where you have to begin. And that's where we start. And then that also provides, fortuitously, a basis for moral action by those countries that have fiscal. Turning to Martin, I think he did a wonderful job of pulling things together. I really want to emphasize some points on his last slide that he and I have discussed, and which may be self-evident, but I think are nicely put, that ultimately this is a biologically driven shock. We are all working in the sort of mainstream models for what we've learned from epidemiologists, virologists, and other medical doctors, that our biggest concern was overloading the healthcare system, particularly ICU and respiratory capacity, and B, that we expect this to be a somewhat normal flu-like disease in the sense that people who get through it do acquire some amount of lasting immunity. These are very big assumptions, and there are occasional spotty checks on the second assumption about acquisition of immunity in the absence of a vaccine. This is the nightmare disaster scenario. If it turns out that that is not possible, or the diminished immunity acquired is only very temporary, only for a limited source of people, then the testing and reopening regime that our colleagues have referred to, and that people in Northern Europe are starting to experiment with following the Eastern Asians, that rolls back. And so I have no expertise whatsoever to judge that, of course. But I just want to emphasize that if people ask, what are you assuming on the biology and the disease for your forecast, that to me is the critical assumption and the one that transforms everything if that turns out to be wrong. But let us pray, hope, and expect that that is not wrong. And now let me say a few words jumping off of Karen. Karen, I think, rightly implied or said that we expect to be, her forecast and my forecast personally is actually very similar to hers, it turns to be leapfrogged to the downside, probably by the IMF with their forthcoming WEO, not that we have any information inside, probably from the investment banks. Everybody, tends to be what happens in a crisis. The incentives are to cascade further. There are also very good intellectual reasons for people to be negative. As Karen mentioned, a number of our colleagues in the Peterson community are more negative than Karen. I want to point out that Karen's point estimate for the decline in Q2 in the US is actually more negative than the current consensus as printed, but I think the current consensus is actual. She's probably towards the upper end. Similarly, on unemployment, her statement and that of our colleague David Wilcox about something around 20% or more measured unemployment in the United States is a number that you're starting to hear. You know, Jim Bullard from St. Louis, Fed St. Louis, and others have come out with these kinds of numbers. We would expect that other people are now going to go above that number. Where I want to come down, just speaking for myself about the US, and then a couple very rapid observations about other countries in comparison, is that as opposed to most people who would take the under in terms of growth on Karen's forecast, I would take the over. The over is still pretty bad in human terms and in economic terms, but I think we are meaningfully going to recover faster than many people are now expecting. As Karen mentioned, I think in terms of the check mark recovery, which is more actually like that, meaning that you go down at incredible speed, you recover nothing like that speed, but still at a market upward slope for an extended period. Now, again, taking the caution that Martin rightly raises about the issue of second wave, I'm going to point out a few reasons, I think, for relative optimism. The first is, I think we underestimate the resilience of the small business sector and the employees of the small business sector in the US and in the advanced economies. This is not because I have some starry-eyed Ayn Rand vision of the world. This is because of the sad reality that for most of these people over their working lifetimes, they will have several experiences of business failure, of job dislocation, of having to start over, of being out of cash flow. And so while in the aggregate, this is happening to an extreme degree right now, and therefore for people of privilege and for macro forecasters, which overlap a lot, this is something striking. The reality is that these are workers and entrepreneurs and business owners who are accustomed to restarting again. There's a very nice quote about this from a restaurant owner in the New Yorker, of all places, a week ago. And I think we overestimate the amount of scarring that goes on. I would also point out that as much as intuitively and moral sense, I had expected the results of the great financial crisis a dozen years ago to be extensive scarring. What we have found actually is that evidence for hysteresis and scarring is much less than we thought. It took a while to get back to full employment, but even people like me who were on the upside, the labor force participation returned to higher levels than many had expected. I think the second point is that given the kinds of cash flow data that Karen raised and that others have raised, it is probable that the damage to the small business sector is extremely front-loaded. That rather than the damage just continuing to accumulate, a lot of it happens in the first 2-3 weeks, especially with the policy coming down the pike. And so therefore, I'm not sure that the kind of sharp downturn that we have extends, at least in that form, of business failures in the small business sector, even for several weeks. Now, again, none of this saying things are good. This is still going to be a negative quarter, the likes of which we've never, ever seen, and the amount of human pain will be hard. But when I speak about forecasting, I think the downside risk and the resilience is higher than people expect. I would also suggest, just copying Karen, the amount of policy stimulus coming down the pipe, up to 15% of GDP, is enormous. And it is being dispersed in an incredibly efficient manner by government standards, an incredibly efficient manner in terms of speed, very little wastage, direct cash to individuals, very high multiplier in an environment where there's no crowding out of private sector investment, no interest rate response. This is going to be a fiscal stimulus the likes of which we've never seen. Olivier is, of course, absolutely right. Right now, it's being spent just for survival, both in the corporate sense and in the human sense. But even then, as Jason has pointed out, Jason Furman has pointed out in Karen's sites, the numbers in terms of income replacement, be it France, be it the US, for people at the low end of the income distribution are extremely high. And so the power of this policy stimulus, I think, should not be underestimated. I would come out with two other points. First, on the biological side, I had my attention drawn about a week ago to a study by Nathaniel Hubert, of Weill Cornell and co-authors, which has suddenly started getting some press attention. It's one of several studies and indicators suggesting that we may have vastly underestimated the contagion of the disease, and that the number of people out there who've been exposed to the disease is perhaps an order of magnitude higher than we currently think. And there is anecdotal and stylized facts that fit very well with this from Denmark, from South Korea, from elsewhere. They, of course, are relying on very micro data in the New York area and have various sources. But the clear implication of this, even for those of us who are not trying to be epidemiologists, is then if the disease is spreading very quickly, then the number of people who are asymptomatic or have symptoms not sufficient to drive them to the doctor is quite low. And the mortality rate, even allowing for the cautions that Martin rightly raises about undercounting mortality, ends up being much lower than we expect. And God forbid that this should be wrong. We will see very shortly, we will be able to find out if this is wrong. But if this turns out to be right, then this is a game changer in terms of how we think about the future countries, particularly in emerging markets that have, and developing world that have to cope with this, but also for our forecast. Because then one is talking about a very wide range of people acquiring immunity quickly, a much lower set of number of people suffering horrible damage or death. And that also leads to a faster rebound. So I don't want to be a Pollyanna, but I do think as a matter of forecasting, I will take the over. The final point is, how does this analysis of what I said apply beyond the US to other countries? I think Europe is going to be very much the same. Olivier, in other contexts, and our colleague Jean-Pascal Ferry and Jeremy Cohen-Saton have documented that some of the differences between the European and the American fiscal stimuli are quite overstated. That a lot of this is different forms by institutions, but you still have the bulk of money going towards associating people with their current jobs, income replacement, small business bridge loans, and so on. And so I do expect a similar kind of massive policy improvement in Europe. I do think, however, one would be still expecting Europe to do worse, partly because insufficient solidarity has been shown. So you will continue to have a 150, 200 basis point premium on Italian and other debt, which does matter in this context. Insufficient solidarity has been shown, so there will continue to be uncertainty premia in Europe. And additionally, as a more trade-heavy, manufacturing-heavy economy, particularly in Germany, but elsewhere in Europe, compared to the US and the UK, they will suffer more from the lagging effects of diminished trade. So I think that there will be some divergence in terms of not so much the downturn or the policy, but the net speed of recovery in Europe will be lower. I am very worried about Japan. In the end, this is a biological shock. And as the US is demonstrating at great human cost, as the UK demonstrated, but rightly reversed itself, as others have demonstrated, if you get the healthcare wrong, the public health wrong, nothing else really matters. And this is especially true in today's information age, where investors and citizens and people around the world can see what others are doing. And so if Japan does happy talk instead of testing, instead of quarantining, and says, we're Japanese, we're different, we bow, we don't shake hands, we all wear masks. But the evidence, as Martin showed, is quite frightening about a new breakout in Japan. Then Japan will not be able to recover quickly, no matter what the stimulus effect is. And if you, as was the case initially in China, if you have distrust of where the authorities are, then that makes it even harder to get people to take the necessary measures than yes. So on Japan, I would take the under. Thank you all for your patience. A number of you have posed questions to the Q&A, which I'm grateful for. The first one comes from Prakash Langani of the IMF to Olivier. Olivier, in EMs and low-income countries, should the standstill cover official as well as private debt? And are capital controls and outflows needed in emerging markets and low-income countries? Olivier.
So these are discussions I've had, I think, even with Prakash and people at the IMF, and there's no simple answer. Ideally, clearly, you'd like with that the debt standstill to be as general and apply to as many creditors as you can, but there's a question as to whether you can actually do it or not. You have to worry about the possibility that, as we saw, say, in Argentina in a different context, official money goes in and it comes out to repay the private creditors, and that you want to avoid. That's conditions under which I think considering capital controls on the combination of debt standstills on what you can do and capital controls on as much of the rest as you can get your hands to is probably a good way to go. But again, that's a country by country discussion. I'm happy to have it off this meeting bilaterally with Prakash. You're mute.
Yes, I am dumb and mute, apparently. The next question is from Needy Bala Johnson of Liberty Mutual Insurance. She asks, are you observing coordinated preparedness between federal government, state and local governments, monetary policy, and treasury to get ready for gradual reopening in phase 2? Let me turn that to Karen, although I can pitch in on monetary.
Sure, thank you. Yeah, I'm fairly confident that there's good coordination between monetary policy and the Treasury. That's what we saw in the last crisis. That was my experience at the Treasury Department. And of course, the money in the CARES Act for the guarantees for the Fed program are just requiring them to work closely together. I don't know the degree to which state and local governments are working with the federal government. It's actually quite important, as you realize. I expect there's been coordination on the small business loans, and there's been coordination to get some of the funds in the CARES Act. I don't know the degree to which it's going smoothly.
Thank you. I don't have anything terribly innovative to add. I would just say that it is worth tracking carefully, as I'm sure you're aware, Needy, the programs that are genuinely fiscal and treasury programs that get masked as Federal Reserve programs in a bizarre twist of administrative fate, but are ultimately really fiscal programs that eventually get, frankly, delegated to the financial sector. So subject to that. Yeah, Olivier.
Yeah, I mean, I'm struck by, again, the comparison between the US and France in the allocation of ventilators, for example, and the fact that in France, ventilators have gone from one province to another as a function of relative needs. And in the US, because of a lack of federal guidance and organization between states, we've seen that didn't happen in New York, where it could have happened. So that's not monetary fiscal cooperation, but cooperation between the various actors can make a gigantic difference. In France, we never ran out of ventilators, even at the worst of a crisis, by just moving them around. It might have been doable here. It was not. No.
Sigh. Very well, aptly put. The next question is from Phil Levy. It's a question to Karen. Karen, how do we reconcile the predictions of a relatively quick GDP bounce back with the data you showed for limited cash balances of consumers and small businesses? Is this entirely reliant on relief funds arriving before evictions and bankruptcies bring irrevocable changes?
Thanks, Phil, for that question. No, it's not entirely relied on that. I mean, it's relying on some of the factors that Adam talked about. The fact that the jobs, I think the jobs are there and people want to take the jobs as soon as we get the issues related to the pandemic behind us. So I just do feel like it's different from a normal recession where you went in with some sort of imbalance and overbuilding in housing, or there was a collapse in aggregate demand that's going to be persistent for some reason. But I would say, in addition to the kind of relief funds getting to people, the other thing that is really, really important is forbearance on loans and on things like rent. There, I will say, is we've taken some steps already. The CARES Act kind of formalized the hold on evictions and foreclosures for loans that are backed by the FHA or the GSEs. We put student loan payments on pause. I think we need to kind of do more policy-wise. So I think, for example, we haven't really done anything for renters. We need to do something for renters. But at the same time, remember that it's not in the banks or in landlords' best interest to foreclose on these people, because they will be okay, in these businesses, because they will be okay kind of once we get the virus stuff behind us. So I think they have a very strong incentive to exercise forbearance. I wish we had more in place to kind of formalize that, but I do think that's a really important piece. That's a complement to getting those funds out there.
Yeah, and Phil, I would just repeat what I was saying a few minutes ago, that I think we have a misperception, at least in the US, of the resilience and the constant turnover in small business. I mean, Karen is absolutely right that mortgage forbearance is particularly crucial for retail-facing and personal service businesses. But subject to that, in the landlord's own self-interest, I think the bounce back on limited cash balance is something that a lot of these businesses are accustomed to. And these are not large franchise, large upfront investment businesses in a capital sense. Again, the human pain is going to be terrible, but if you think about what the usual churn is for these businesses, this may not be as difficult as people make it out to be. The next question is from Mark Siegel of Elliott Advisors. What do the speakers think about the odds of material and persistent deflation? Let's start with Olivier.
So I think we have to distinguish between now, where clearly there is a number of products which are in short supply and their prices are going up. So I wouldn't be surprised that the inflation rate for a month or two might actually be higher. After this, again, pent-up demand may also lead to a bit of inflation on some goods, the goods that you couldn't buy before. But I think the tendency is still for weak demand thereafter. And other things equal, I would expect more. I think on Karen's side, I think the probability of deflation or lower inflation is higher than the probability of higher inflation. I can see in the very distant future, if the debt burden became unbearable, that we might resort explicitly to inflation. But again, this is in the very distant future. I think in the short run, I think there'll be a tendency to have deflation. Monetary policy will not be able to do much about it. Therefore, this might lead to longer fiscal deficits, longer fiscal support, and further increases in debt. Again, in my book, that's not the end of the world, but it may, again, make some people a bit worried.
I would just add that we've had a very long stretch across many countries now of mechanistic monetarist views of inflation being disproven. Everything that's happened with central bank balance sheets, everything that happened in Japan, you end up having to resort to very strange ideas about why inflation hasn't happened up till now, if you're going to assert that this fiscal policy or this monetary policy is now suddenly going to cause inflation. Again, you can have multiple equilibria, as Olivier pointed out. And again, there is a very steep divide in the world between those countries that are deemed by markets and their publics, more importantly, to have fiscal room and those that are not. That is a yawning divide, and the differences will be amazing. But absent in the kind of world we live in the rich countries, based on a panel of all the rich countries for the last 15, 20 years, it seems very difficult to get inflation sustained without sustained wage increases. And we're not seeing those. It's hard to imagine getting those in this environment, in my view. The next question we have is from Stephanie Siegel, I believe it's CSIS, to Karen. Thank you for the 3 excellent presentations. Thank you, Stephanie. Does the checkmark recovery in Karen's forecast take into account China's experience per Martin's presentation of returning to only 80% capacity? given where China, Korea, Singapore are with testing, data collection, and control, for example, QR codes, are they in a relatively better position than the US and Europe for rebounded activity? Actually, this is a question for Martin, and I know he's prepared. Martin.
Thank you for that. We did have a discussion before the outlook, which did incorporate both my views and those of Nick Lardy on the Chinese economy. What I would say is that it's not actually quite as gloomy as one might expect, because China still has quite a high growth potential, and very importantly, they've kept their powder dry in terms of stimulus. So they are still able to do something of quite a large percentage of GDP later that could bring that back up. And the second fact is that, you know, it's one of the reasons it's stuck down is that the U.S. and Europe are in the worst downturn period, and hopefully will be returning back to capacity in the coming months. And so that is going to be that's going to make it easier for them to reach that higher level. And if more countries are improving at the same time, then other countries should be able to get above that 80% because global demand is going to return. And then on the second question about the contact tracing and all this, I definitely do think that the East Asian countries are, especially countries like Singapore and Korea, Taiwan, are better placed than the United States at this point to mount a coordinated response and have the kind of contact tracing automated and working. And that should be concerning for how we think about how long it's going to be before we're able to reopen.
Can I come
yes,
in and have a follow-up question to Martin, which is the 80%, is it in your mind mostly a supply constraint or a demand constraint? Because if it's a supply constraint, then, you know, increasing demand is not going to do much. You have a sense of which one it is?
I would say, if I were to estimate it, maybe 80% demand and 30% supply at this point. Much of the country is back open, and the vast majority of migrant workers have returned from their villages to where they work. A large number of factories are operating, and they're just waiting for that global demand to come in. You know, enormous quantity of orders have been canceled. So I think they're further along towards reopening the economy than that 80% factor might suggest.
Next, we have a question from Vikram Nehru. East Asia includes Southeast Asia. What are your projections for them, especially Indonesia? Also, thoughts on India's response. I'm going to turn this to Karen because she gathers the information from our full network of fellows. Karen, you're muted. I am unmuting you.
Okay. Yeah, Southeast Asia is not, I didn't show formal numbers for that, but I'm sort of been assuming, based on what I've been hearing from our scholars, that they will see a soft year, not a kind of plunge like we've seen in the higher income countries, but then a comeback next year. I think one thing that we talked about with India was that there is this larger informal economy in India, in many of these countries. The downside to that is that it's harder for the government aid to reach people to the extent there is government aid, but the upside of that is that it can make them quite kind of dynamic in terms of being able to come back, you know, following the shock.
Thank you very much. As you know, our colleague Arvind Subramanian is continuing to be very active in the public discussion in India, and there is obviously a huge, as Karen referenced, a huge question between the fundamental structural issues in India, including the incredible loss of income for people in the informal sector under a lockdown, as well as their sense of having policy room. And this is non-trivial to sort through. I recommend the work of our colleague Arvind. The next question is from my longtime colleague, former Bank of England policymaker, Sushil Wadhwani, and I think it's meant to catch me out. Sushil, oh no, it's for Karen. Her question, GDP forecast seems to assume little need for a second lockdown. Yet that was the baseline assumption in the Imperial College study and influenced the UK government hugely. Why do you believe the epidemiologists at Imperial are wrong about future lockdowns, please? Before Karen answers, I will just say, Sushil, if it turns out this new set of studies coming out emphasizing that we have much more infection, much more widespread, and much lower rates of mortality and morbidity as a result, then the idea of the second lockdown becomes less and less likely, subject to the kinds of situations Martin described about imported hotspots and localized hotspots. But Karen, do you want to talk about what are your assumptions on the epidemiological side?
Yeah, I mean, I think, the check mark's a stylized example. I think that's going to be the kind of low frequency contour of what's going to happen, or at least that's my best guess at the most likely case. I think, actually, particularly on a higher frequency basis, we're going to kind of see an unevenness. We're going to kind of open up. We're going to start opening up the economy gradually. Then there's going to be a setback because we'll see kind of cases rise again. So we'll have to do a bit of we'll have to backtrack a little bit, but then we'll be able to open up some more. So I think if you're actually looking at kind of monthly or weekly data, what you'd see is more ups and downs. But the reason I'm not projecting, something like a W or something that turns into a Great Depression is that I think we do have kind of more public buy-in now that these containment measures work, because we were seeing it bend in the curve in different states. I think there is now a kind of a laser focus on kind of the data in terms of deaths and in particular hospitalization. I think we'll have more data. So I think we will know if we're seeing this kind of, if we're seeing that our opening up of the economy is actually kind of hurting us in terms of the situation around the pandemic. I will say that my expectations are all conditioned on the fact that we'll be able to do more testing, but really much more testing. And if we don't get our act together in that regard, then I think you could see something like a more serious setback.
Thank you. Karen, the next question is also to you, and I think it's a logical follow-up from Rosalind Jordan of Al Jazeera. The Washington Post is reporting that the president wants to reopen the country on or about May 1, in part because of his concerns that the economic downturn is hurting his political future. Setting political concerns aside, if the US went back to work in 3 weeks and a new surge of COVID-19 cases erupted, what might be the impact in Q3, Q4 economic growth, as well as on the long-term recovery trends?
I think if we were to fully open up the economy on May 1st, that would be, and not to, change our minds and reverse that decision, I think that would be a disaster for the economy in the second half of the year. I just think this kind of starting, and so I think, two things there. And one is, it's not, even if you say the economy is open again, it's not like people are going to start flooding into the restaurants when we can see what's going on with the virus, in terms of how dangerous it still is. But the second thing there is that I think we could see, again, another kind of rise in deaths, and that's going to make us, have to, that's going to be a big problem. And there's going to be states that are basically then clamping down again on economic activity. So it's just going to kind of slow the healing process. Great,
thank you. Continuing in Karen's vein, but others may have an opinion, from Merit Janow, the School of International and Public Affairs at Columbia, what is your assessment of how the US is doing in moving towards generalized testing and tracking regime being developed? I think the answer is it varies a lot by state, unfortunately.
Yeah, that's my sense too, that it does vary by state, and that we could use better coordination on that front. I don't think that we have made good general progress in that regard.
I mean, this goes back to Olivier's point about when there's federalism, when you need it. There is a lot of news, Merit and others I'm sure you're well aware of, about faster, more dependable, cheaper test kits of various kinds in production. I'm not going to name specific companies, and some are patented, some are not. But a number of the medical people I'm talking to seem to think that at least in New York and California, you could have at least the materials for large-scale testing in the near future. The issues, which Martin might want to talk about on another occasion, have to do a lot with questions of privacy and implementation that he's been writing about, which are very different, as we know, across the US, let alone across countries. So sorry to sort of punt your answer, but the supply constraint on testing is really not going to be the issue, not that you thought it was. It is going to be this divergence probably in local governments and local conditions. The next question is from David Orden of Virginia Tech. We are seeing evidence of states cutting back even as federal stimulus expands. Does anyone want to comment on how best to avoid this mismatch and disruptions it may cause? He adds, so Karen and Olivier, perhaps you could tackle that.
So I think what's going on with states is I mean, again, there's a lot of variation across states. I think, first of all, they're very distracted by what's going on in their healthcare systems right now. That we've sort of said we're going to get them more funds, but that's going to take some time to do. So they are squeezed in the short term, but also they need more funds. So the amount of money that we've kind of said we're going to push towards states in the CARES bill, that's not enough. They're going to need much more money to cover what's going on in terms of both their need to provide social services and the hit to tax revenues. So I think what's going on with some states now is they're doing the prudent thing and they're cutting back because they don't have that kind of assurance that there's going to be more federal money coming. I think it will be coming, but what I think we need to do is I think we need to legislate now more money for the states.
Great, thank you. Unless Olivier wants to add something, this will be the final question because we have reached our 1:30 hour. Thank you all for working with us in this new system. The question comes from Christian Orsini. Two questions. Question for Karen. A key aspect of the recovery is how fast workers will go back to employment and prevent hysteresis effects. Is there an estimate about how many workers were furloughed and how many were permanently laid off? Is there any evidence that firms are using more of this instrument? And a question for Olivier, can furloughs in the US be compared to short work time arrangements existing in Europe? So Karen.
Yes, I've heard the same anecdotal evidence you have, that a lot of firms are furloughing workers. I've also heard stories about firms that are laying off workers, but basically on the assumption that when demand comes back, those workers will be easy to, or at least the ones they want to keep will be easy to rehire again. I have not seen any hard data in that regard. I don't know whether it's something that kind of they're collecting data on in the UI claim system, but I mean, I looked at their website a week ago and I didn't see anything there. But I think it would be really useful information to when you're thinking about, kind of the forecast.
Good. And with respect to the France versus US comparison, I feel fairly strongly that the French way is better. This is not a general statement about the French way, just in this particular case. Keeping the workers in the firms has a number of advantages, and psychological, obviously, but also they keep everything else in the wage, the health package and so on. And it makes it much easier to actually get them some money right away, because the firm, even if it doesn't have much cash, can actually pay them a week or two just before the administration gets its act together and the banks are able to advance credit to the firm. So I think that the French experience so far is working well. People are getting money. Some firms have advanced the money and have a hard time getting credit from the banks. The banks want to be sure that they're not taking credit risk. This is taking a bit longer than one would want. But on that, I think that's probably the way to go.
Thank you, Olivier. We have a number of questions still in the queue, but we are required to end on time or close to it. Please accept my thanks to all of our stakeholders who joined us on Zoom and all of our friends and interested parties who joined us online. These presentations in video and the slides will all be available, if they're not already, on the Peterson Institute website, www.piie.com. And we look forward to more feedback from you on the substance of these presentations, on the shape of this call, and since we are probably still going to be on lockdown, feedback from you on how best to manage these large events as we find our way forward together. My special thanks to my colleagues for their excellent presentations, Martin Chorzempa, Olivier Blanchard, and most of all, Karen Dynan.